Have you ever wondered why 90% of traders fail, even when they know technical analysis? Why do so many traders blow their accounts despite having great strategies? Here's the truth. It's not your charts, it's not your indicators, it's your mind. In this video, I'll show you why mastering your psychology is the single most important factor in trading success, and how combining it with ICT concepts can make you a truly consistent trader. By the end, you'll understand what trading psychology really means, how to overcome fear and impulse, and how ICT tools like fair value gaps and order blocks can help you stay calm, disciplined, and profitable. Here's the reality. Most traders fail not because of poor strategies, but because they lose control of their emotions. Fear, greed, and impulsive decisions destroy accounts faster than any technical mistake. You might have experienced it yourself. The fear of missing out makes you chase a trade. The frustration from a loss makes you revenge trade, or the anxiety of uncertainty keeps you from pulling the trigger on a perfect setup. The markets are designed to exploit your weaknesses. Every emotional reaction is a trap, and if you don't master your mindset, you'll keep falling for it. You'll keep bleeding money. But there's good news. ICT concepts provide the tools to trade like smart money: calm, patient, and precise. And when you combine those tools with the right mindset, you'll finally break free from the emotional traps holding you back. Here's the first truth about trading psychology. Your mindset controls everything you do. Trading is not just about strategy. It's about how well you execute that strategy under pressure. Think of it this way. Imagine you're learning to drive a race car. The car, your strategy, might be perfectly built for speed, but if you panic at every turn, you're going to crash. That's exactly what happens when traders let fear, greed, or uncertainty take over. Trading psychology matters because your emotions dictate your actions. Even the best ICT concepts, fair value gaps, order blocks, and liquidity pools won't work if you let emotions cloud your judgment. ICT trading concepts are designed for precision. You need to trust the setup, trust your process, and stick to your rule. When you do that, you trade with confidence, not emotion. For instance, let's say you're watching price retrace into a fair value gap. If you hesitate because of fear, you'll miss the entry. Or worse, you might jump in impulsively before price reaches your level. Both mistakes come from a weak mindset, not a weak strategy. The takeaway is this: your success as a trader is directly tied to how well you manage your emotions. Master your mind and the charts will follow. Now that we understand why psychology matters, let's talk about the most common psychological traps that traders fall into. These are the emotional landmines that can blow up your account if you're not careful. Trap 1. Fear of missing out. FOMO is one of the most dangerous traps for traders. You see price running in a direction, and the fear of missing the move makes you jump in impulsively without confirmation. For example, let's say price is approaching a fair value gap, but instead of waiting for it to fill and confirm your entry, you jump in early because you're afraid you'll miss out. More often than not, the market punishes this impatience. To overcome fear of missing out, trust the ICT tool. Wait for price to trade into your level, like a fair value gap or an order block. Remember, patience will save you far more money than impulsiveness will make you. Trap 2. Revenge trading. Revenge trading happens when you try to make back a loss quickly by taking impulsive trades. It's driven by frustration, not logic. Let's say you took a losing trade because you ignored your rule. Instead of stepping back to reassess, you jump back into the market immediately, often doubling your risk. This leads to even bigger losses. When you lose, stop. Take a break. Review your trade and ask, did I follow my process? If not, accept the loss as a learning experience and wait for the next clean ICT setup. Trap 3. Impulse and overtrading. Overtrading happens when you take too many trades, often driven by boredom or a need to feel productive. It's one of the quickest ways to drain your account. Imagine you're watching charts all day and nothing is happening. Instead of waiting for an ICT kill zone or a valid setup, you start taking random trades just to feel busy. This leads to poor risk management and unnecessary losses. To avoid overtrading, stick to a trading schedule. Focus only on key ICT concepts like kill zones, fair value gaps, and order blocks. Trade less, but trade smarter. Each of these traps, fear of missing out, revenge trading, and overtrading, comes from a lack of emotional control. Recognizing them is the first step to overcoming them. Here's where ICT concepts become more than just technical tools. They become psychological tools to keep you disciplined and precise in your trading. Tool 1, fair value gaps. Fair value gaps are areas of price imbalance where the market has moved too quickly. They are magnets for price, offering precise entry points for patient traders. FVGs teach patience. Instead of chasing price, you wait for it to retrace into the gap. This eliminates impulsive entries and helps you trade with confidence. If price rallies quickly, creating an imbalance, you don't chase. You wait for it to retrace into the FVG, and only then do you enter. Tool 2, order blocks. Order blocks are areas where smart money has placed their trades. They often form at liquidity pools and act as key zones of support or resistance. Order blocks build discipline. When you focus on trading at these zones, you avoid random trades and impulsive decisions. Instead of entering trades in the middle of nowhere, you wait for price to retrace into an order block. This keeps you aligned with smart money. Tool 3, kill zones. Timing, ICT. Kill zones are specific time windows when the market is most likely to deliver high probability setups, such as the London and New York sessions. Kill zones give you structure. By trading only during these windows, you reduce overtrading and focus on quality setups. For example, during the New York kill zone, 8:30 a.m. to 11 a.m. EST, price often shows clear reversals or continuations. Sticking to this time frame helps you avoid emotional trades outside of it. ICT tools like fair value gaps, order blocks, and kill zones are not just technical concepts. They are psychological tools that keep you patient, disciplined, and focused. To succeed in trading, you need to master your mindset. We covered why trading psychology matters, the emotional traps that hold traders back, and how ICT concepts like fair value gaps, order blocks, and kill zones can act as psychological tools to keep you disciplined and precise. Remember, the market rewards discipline and patience. It punishes impulsiveness and emotion. By mastering your psychology and applying ICT tools, you can trade like smart money and finally achieve consistency. If this video helped you, hit the like button and subscribe for more trading insights. And don't miss my next video where I'll share more strategies to help you think and trade like a professional. Thanks for watching, and I'll see you in the next one.